Bitcoin is up over $2,000 in a single push, and right now, every retail trader is asking the wrong question. They see a plus 3.4% candle and think the bottom is in. But the daily trend is a strong sell. The weekly, strong sell. The monthly, strong sell. Yet the 1 hour and 5 hour charts are screaming strong buy. That is not a reversal signal. That is a textbook liquidity trap. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. Here is my session verdict. The intraday bias is a fading rally. We are trending higher on tiny timeframes, but we are colliding directly into a multi-timeframe brick wall, and that wall sits between 60,800 and 61,059. Until I see a clean hourly close above 61,200, this is a bear market bounce. Write this number down. If Bitcoin closes a 4-hour candle above 61,200, the entire daily structure resets and I flip neutral. Below that, every pop is a short setup. Right now, the herd is positioned for continuation. Long positions are piling in after that plus 3% move, and open interest on perpetual swaps just spiked. When the crowd leans long into a wall of weekly selling pressure, the market often does one thing. It hunts their stops. Let's zoom out and walk the chart from the weekly down to the 60-minute, because the conflict between timeframes is where the money is made. On the weekly, price is under every major moving average. The MA20, around 62,400, is sloping down. The 50-week equivalent, the MA50, is at 66,158 and dropping. The 200-week sits all the way up at 76,948. That is the definition of a bear trend. Lower highs, lower lows, and price trading well below the mean. The weekly MACD is deeply negative, and while the histogram has stopped accelerating lower, there is zero bullish cross. So if you are a swing trader, your lens must respect this. The trend is down until proven otherwise. Drop to the daily. Price today touched 60,630, and that's the highest we've been in over a week. But look at the moving averages. The 20-day MA is at 62,409, still declining, and price hasn't kissed it in 3 weeks. The 50-day is at 66,158, and the 200-day at 76,948. This bounce hasn't even reclaimed the first resistance level, R1, at 59,845, and yet we are already seeing exhaustion. The daily RSI just ticked up to 39.3, still in bear territory, nowhere near a momentum shift. The daily MACD is at minus 2,630, deeply underwater. What concerns me is the stochastic. On the daily, it shot up to 90, overbought on a strong sell trend. That's a classic rubber band stretch that snaps back hard. Now zoom into the 4-hour and 60-minute. This is where the bounce looks real but fragile. The 4-hour is a buy, the 5-hour is a buy, the 1-hour is a strong buy. Price gapped above the pivot point at 59,017 and ran through a 1. We are now wedged between R2 at 61,059 and the psychological 60,800. The 60-minute chart shows a series of higher lows, and the 5-period MA at 59,999 is acting as dynamic support. But I want you to look at the Williams percent R. It's at minus 9. That is essentially max overbought. The CCI is at minus 80, which is not extreme, but the combination of overbought stochastic and extreme Williams percent R on a 1-hour strong buy inside a daily strong sell is exactly the recipe for a violent rejection, and here's what most traders miss. The volume profile on this bounce is thin. We pushed over $2,000 on a Sunday night Monday morning session with no real institutional flow backing it. The ATR is 2,152 points, so a 2,000 point move is merely one average day's range. But the key is where that range sits relative to value. The value area low on the daily sits around 57,800. We are now $3,000 above that, meaning we are at the top edge of the value range with higher timeframe sellers waiting. This is the trap. The rally looks convincing, but it's a liquidity-seeking missile designed to take out early shorts and invite late longs before the real dump. Now, I want to show you the hidden divergence that changes the short-term game. On the 4-hour chart, price made a higher low compared to last week, but the MACD histogram made a lower high. That is a textbook hidden bearish divergence inside a downtrend. It tells me momentum is fading even as price ticks up. Furthermore, the ADX is only at 27, which is below the 30 threshold that signals a strong trend. That means this bounce lacks trend strength. It's a noisy, choppy rally, not an impulsive reversal. But here is the kicker. If the divergence plays out and we reject, the stop-loss orders resting above 61,200 become the fuel for the next drop. Conversely, if that hidden divergence fails and price powers through 61,200, it would mean the bearish momentum has exhausted, and we could see a short squeeze towards the daily MA20. That's the pivot point that flips the script. Let's connect the last 24-hour news to this price action, because macro is the silent driver. The headline screaming right now is Bitcoin trapped at $60,800 resistance, and analyst articles are flagging Bitcoin nears major low as Elliott wave and momentum divergences signal reversal. That sentiment is tempting, but I need you to look at the risk asset shadow. Bitcoin's correlation with the S&P 500 has been near 0.7 over the past month, and last night Nasdaq futures barely budged. If equities didn't give us a risk-on green light, this crypto bounce is standing on one leg. Funding rates on perpetual swaps flipped slightly negative over the weekend, meaning shorts were paying longs. That negative funding often precedes a short squeeze, but the bounce we just got is the squeeze. Now funding is flattening, and open interest is rising. That's a setup where late longs get trapped if price fails at resistance. Institutionally, we've seen Bitcoin ETF flows remain tepid, and the CME futures basis is actually contracting, suggesting smart money is fading this rally. The dollar index is steady, and bond yields aren't collapsing, so there's no safe haven rotation driving this. It's purely a technical, over-leveraged bounce. My 1 to 2 week directional lean, I want to sell rallies until the weekly trend flips. The event that invalidates that lean is a daily close above 62,500. If that happens, I'll admit the bearish thesis is wounded. But right now, fading strength is the high probability path, second interaction trigger. Do you think Bitcoin breaks 61,000 today? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 3 precise trade plans, 2 scalps and 1 swing. I'll speak the entries, stops, and targets, and you'll see on-screen trading cards so you can screenshot them. Scalping setup number 1. The opening scalp, we call this the fast snipe. The intraday structure is bullish on the 60-minute, so we want to buy a pullback into a proven level. The level is the psychological 60,000 zone, which aligns with the 5-period MA at 59,999 and the bottom of the overnight demand. Here's the exact trigger. Wait for a 5-minute candle to dip into 60,050 to 60,100 and print a bullish engulfing pattern with the RSI hooking up from 40. The entry is on the break of that engulfing candle's high, roughly 60,150. Stop loss goes below the recent swing low at 59,850. That's a 300-point risk. Take profit 1 is at 60,750, just before the 60,800 resistance, for a 1:2 reward. If momentum rips, you can let a runner hit 61,000 for a 1 minute and 2.8 seconds risk reward. This scalp is instantly voided if a 5-minute candle closes below 59,900. That would mean the buyers have stepped away and the pivot is lost. The opening SCLP entry, 60,150, 5M bullish engulfing break after tap of 60,100 zone, stop loss, 59,850 take profit 1, 60,750 take profit 2, optional 61,000 risk, reward, 1:2.0R, TP1, 1:2.8R, TP2, invalidation. Void if 5M candle closes below 59,900. Scalping setup number 2. The liquidity grab now. This is my counter noise short scalp, and it's designed to catch the stop hunt above resistance. Look at the 15-minute chart. We have a clear cluster of sell orders and stop losses sitting just above a 2 at 61,059 all the way to 61,200. In a strong sell daily environment, market makers love to spike through that zone to trigger stops and then reverse violently. The setup: wait for a sudden wick above 61,200 on a 5-minute candle that immediately fails and prints a bearish engulfing or a long upper wick reversal. Entry is on the break below 61,000 with strong selling volume, so you're short at 60,950 after the fakeout. Stop loss must be tight. Place it at 61,250, just above the expected wick high. That's a 300-point risk. Take profit is the nearest intraday liquidity pool at 60,400, which aligns with a prior consolidation node. This scalp demands fast execution and is only valid if the spike happens and reverses within 30 minutes. If price hangs around above 61,000 without rejection, do not take it. The liquidity grab entry, 60,950, on break below 61,000 after a spike above 61,205 bearish engulfing, stop loss, 61,250 take profit 1, 60,400 risk, reward, 1:1.8 R invalidation, void if no spike above 61,200 within the first 4 hours of the session. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Swing trade, the session swing. This is the trend alignment trade, and it's how you capture a multi-day move. We respect the daily strong sell, so we are looking to short from resistance. The trigger is a 4-hour candle close below 60,500. That tells me the intraday momentum has failed and the rejection from the 60,800 to 61,060 zone is confirmed. Entry is at the market open after that 4-hour close, around 60,450. The stop loss goes above the daily structural resistance at 61,200. That's a 750-point risk, which is well within 1 ATR. Conservative target, take profit 1, sits at 58,000, right near S1 and a prior weekly low. That's a 450-point reward, giving a 1 minute and 3.2 seconds risk reward. A stretch target, TP2, is at 56,775, the S2 support. Once price reaches halfway to TP1, around 59,200, trail your stop to break even. Invalidation for the swing bias. A daily close above 61,500 would break the lower high structure and tell me sellers have lost control. This swing aligns with the strong sell monthly and weekly trend, so the wind is at your back. The session SWNG entry, 60,450, after 4 hours close below 60,500, stop loss, 61,200 take profit 1, 58,000 take profit 2, 56,775 risk, reward, 1:3.2 R, TP1, invalidation. Daily close above 61,500 never risk more than 1 to 2% per trade. Scalps demand even tighter risk. No positions through high-impact news. Stops are non-negotiable. This is how you survive to trade the next big move. So here's the single most critical level for the next session, 61,200. A 4-hour close above that and this bear market bounce becomes a genuine short squeeze threat. Below it, every rally is a short opportunity. Tomorrow, I'll be watching the S&P 500 cash open and the next Bitcoin ETF flow data. Any negative flow could accelerate this rejection. If 57,800 support breaks, the whole monthly trend accelerates and we could see a capitulation move towards 55,000. I'll have the updated blueprint exactly 24 hours from now. If you want the full breakdown on the gold and how its gamma levels are signaling a reversal, that video is live now. Tap the end screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. End with silent on-screen text. Scalp the noise. Swing the trend.